I just have a feeling that there will be a problem with the banks that ignites the systemic problem. And look, more than anything, the central banks, Dunnigan, they may have the most money, but as I've said over and over and over again, they know the playbook. And that's more important than anything. If you understand where we're ultimately going, then only in retrospect will those moves have been obvious. But to me, it is obvious because they know where it's going. And everything that they've done back at it, that they knew the playbook, whether it be Basel III or the reclassification of gold, or all of these decisions, even the new settlement currency and how gold must be held within the borders of the countries that...
Listen, we have some pretty worrying trends, like the unemployment rate and delinquencies and defaults are all rising. Those tend to be secular trends when they begin. They don't stop because the Fed cut by 50 basis points.
Even just for the just completed month of September, gold was up 5%, where the last 5 years in September, gold's been averaging down 3%. Well, it goes up 5. Silver goes up 8. And the GDX was up 3. And it's, oh gosh. And with everything that's going on geopolitically, it's pretty hard to make any, declarative statements about this is going to happen next. I mean, we're living in some unprecedented times. And so people need to stay pretty nimble and try to keep an eye on maybe the big picture, not so much the day-to-day swings, but, ultimately where some of this stuff is headed.
In today's weekly recap, 3 financial experts, Michael Pento, Andy Schectman, and Craig Hemke, talk about the recent price moves in gold and silver and share their insights on what's next in the precious metals markets. We watched hours of footage to bring you the best clips so you don't have to. Smash the subscribe button and turn on notifications so you do not miss out our recaps. Enjoy the episode.
But UBS says gold has risen by 29% this year, consistently breaking records on the way up. Meanwhile, the metal has risen above our long-held year-end target of $2,600, ahead of schedule. And according to the World Gold Council, as I mentioned to you, it has historically rallied as much as 10% in the first 6 months after a Fed cut. We now expect gold to reach $2,750 per ounce by the end of 2024 and to $2,900 per ounce by the third quarter of 25. And so that's pretty significant, but not as significant as Goldman Sachs, who is talking about right now in the fourth quarter of 2025, by the end of the third quarter in 2025, $3,000 gold. By the end of the year in 2025, $3,080 an ounce. And this is elevated from $2,700 to $2,900 an ounce. Again, these banks are coming out and saying, we're moving to $3,000 an ounce. And Goldman Sachs has said that they're being inundated with precious metals requests on their trading desks, which is a very, very, very big deal, obviously. And it is being evidenced by the first time in 2.5 years, we see an uptick in ETF holdings. And so as ETF holdings pick up, as the Fed pivots and lowers rates, probably another 50 basis points here in November, this is just rocket fuel for gold, which has done what it's done, again, rallying 29% and 47% since 2022 when we saw this divergence in 2022 where the ETF started to outflow in the U.S. and gold started to go up, really. And so this 47% gain since 2022, as the public has not been involved in it, with positive real yield and a strong dollar. Now you see dollar kind of hanging right at that 100 mark on the Dixie, and could very well fall from there and drop a little bit or maybe a lot, of course. And then you see that the yields coming down, and now the ETFs ticking up. This is all huge, and to see Goldman and UBS say these things is again very, very significant. They're acquiescing to the reality that, again, you can only manipulate a market over an extended period of time, done again by pushing it in the direction that it is going, and that is the key. That maybe these banks realize it's as dumb as a mud wall, like Bank of America, to be naked short in a market where the rest of the world is voraciously accumulating metal, to the point where just in the month of August, 8.1% of all the silver held that's available for delivery and the LBMA was delivered 8.1% over 25 million ounces in the month of August. So it's accelerating the acquisition of gold. And it's also being done in a manner to not upset the apple cart, as we talked about last week, with 160 metric tons purchased by Saudi Arabia, but not disclosing it the way they're supposed to the IMF, because they don't want to upset the big kahuna, the United States. And yet they're playing both sides of this game. Ultimately, if you just put all of these things together and realize that the commercial banks and the central banks, who are the most collectively well-informed and well-financed traders in the world, are telling you where this is going. And if you don't pay attention to the Goldman Sachs report or the UBS report, where the hell do you find it, right? Where are you going to find it on the mainstream? Are you listening to the mainstream, who isn't saying a word about any of this? It's not easy to find and read through these analyst reports for UBS and Goldman Sachs. It sucks reading it, to be honest with you. And they're 25 pages of a bunch of mumbo jumbo. And then they say, yeah, gold's going to 3,000 by the end of the year. But if you only relied upon, and that you consider yourself very well read by reading the Wall Street Journal, watching Fox News, and paying close attention to the markets, you are missing this completely and totally. There is your massive contrarian indicator. Not only are the biggest boys in the world telling you, yeah, this is where it's going, but you can't find it unless you dig. I don't know. To me, it's a massive contrarian indicator, and I would say that's probably selling it short from where it ultimately goes.
Now, Hemke talks about gold and silver prices and his price targets as he expects the banks to unwind their shorts in the upcoming weeks.
Price would have been weak. Dollar index was rallying, the future rate cut we started the year, they were talking about 7 rate cuts, and that went all the way down to 0 or 1 by June. And under those kind of conditions, you'd have thought that gold would go down. Instead, it's been charging forward all year long. We're currently up 30% year to date. I don't know, how much farther can it go in 1 year? I've said to lots of folks, they'll be like, well, if the banks manage the price of gold, how come it's gone from 400 to, 2,500 over the last 20 years? And that's because, the banks and their traders can profit from a 10% rally because it's up, down, up, that kind of thing. They can manage that just fine. It's 30%, 50, which we've never had a 50% year. That gets them upside down in a lot of their positions. And that's kind of what it seems like they are now. If you look at the Commitment of Traders report, doesn't mean that price can't go higher. It certainly can, but it's going to take more speculator interest, institutional interest on the long side in gold in all its forms, because there's not many shorts left to be squeezed. So it's going to have to be continued buying to keep pushing us farther. That's why things like, we just wrapped up the quarter yesterday. The month-end charts and certainly the quarterly charts are really important in revealing what is a serious bull market. And that's where, that money comes from to keep propelling gold higher, because, people, what is it? The current number is like 72% of all global financial advisors don't even have any gold at all for their clients. If that starts moving up, that's where the continued buying comes from. So anyway, we've had a heck of a year. We enter now into October in the fourth quarter, which, Jesse, all bets are off, man. There's no way of knowing what lies ahead, not just for the precious metals, just for life in general. So it's been a hell of a year, and we'll see where we go from here. All I know is I'm sure glad I own the gold that I do. And anybody watching us wondering about gold, wonder if they have enough. If you have to wonder if you have enough or if you should get any, you probably should get some, because we're in some tumultuous times, that's for sure. It's aggravating for many people, right? Because even though silver closed really well to end the month and the quarter, and you're like, hey, look at that, $31, $32. That's the highest it's been since for a monthly close since January of 2013. So if you've been buying all along like I have and have lowered your cost basis down into the teens, okay, that's fine. But, if you bought, the last silver you bought was in January 2013, you're just now even, right? And so it's just aggravating as all heck. My suspicion is if gold keeps going up, silver will rush again to catch up. That's might have been about the last time we spoke, Jesse. I don't recall. I remember telling folks back in March and in April, as gold was charging, but silver was still around $24, $25. I'm like, well, the gold silver ratio is not going to 100. I mean, eventually silver is going to rush to catch up. And that's exactly, it went from 24 to 33 in about 6 weeks. If gold keeps moving forward here, the same thing will happen again. And you'll get another burst forward. But it is aggravating to watch. There's no question about it. It's thought more as a commodity than it is a monetary metal still by most of the world. And so it kind of has more in common with something like copper than it has gold for the traditional investment strategy, whatever that is. And so we kind of need all commodities to go, kind of forward to drag silver along with it. And we may be on the verge of that. The dollar index is at a very important technical level. If it should start to trade down below 100, that's going to drive a bid for commodities in general. I remember seeing a thing in August that if you look at a basket of commodities, some 20 commodities, as measured, I think it was Reuters or Bloomberg, the hedge funds collectively as a group were more net short that basket of commodities than they'd been in 20 years. And so you think, well, that's got to be a contrarian sign. And so if we get the dollar to fall, we get gold to keep going, silver will rush to catch up again. And we have the chance of finishing the year pretty strong. But again, those are some ifs. And there are I know investing is always about ifs and planning and trying to have as much foresight as you can. But as we enter this final 5-week period before the US election, and with everything that's going on geopolitically, it's pretty hard to make any, declarative statements about this is going to happen next. I mean, we're living in some unprecedented times. And so people need to stay pretty nimble and try to keep an eye on maybe the big picture, not so much the day-to-day swings, but, ultimately where some of this stuff is headed.
In today's news recap, Goldman Sachs sees gold's price at $3,000 by year's end. Analysts at Goldman Sachs see the current dip in gold's price as temporary and expect the price to be at or above $3,000 per ounce by year's end. Goldman Sachs sees continued tailwinds for gold amid an ongoing flight to safety due to geopolitical risks, continued buying of the commodity by central banks, and rising demand among Asian households. Gold demand in China is particularly strong, notes Goldman Sachs, with the People's Bank of China, PBOC, increasing its gold reserves for 17 consecutive months. In March alone, the PBOC added 160,000 ounces of gold to its reserves of the precious metal. The gold accumulation reflects a broader trend among central banks to diversify their reserves and lessen their reliance on the US dollar, the world's reserve currency. Gold's price has risen in recent days after the U.S. Federal Reserve hinted that interest rate cuts could be on the horizon and ruled out any further rate increases. Lower interest rates increase gold's appeal as they reduce yields on fixed income assets such as bonds. Now, we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Go to a few $1,000s an ounce. Because, and I don't know why I went down this road. You have to forgive me. But, gold, AU, comes from exploding stars. And it's an element in the Earth's crust. It's very limited. And you can't create any more of it. It can't be created, okay? And it's beautiful, and it's virtually indestructible, and it's extremely rare. However, cryptocurrencies are based on blockchains, which there are unlimited numbers of blockchains that can be created, where this ledger, digital ledger, where a coin can ride along. So they're not unique. I don't care if there's 21 million units of Bitcoin, because there's thousands of cryptocurrencies that trade that do pretty much the same thing, right? So I'm finished with my diatribe there. Go buy yourself some gold. And listen, I don't sell gold. I'm just saying that if you believe, like I believe, that real interest rates are falling and nominal rates will be capped because the government is insolvent and they can't afford to pay interest on the debt, which is why Mr. Powell lowered interest rates in the first place, then you need to buy gold. They can do that. And they did it with ease because we had a deflationary problem, or at least according to the minds of the government, we had a problem. We can't seem to get to 2% inflation. If only we can get to 2%, because, don't you know, 1.9% doesn't really work. The economy can't function at 1.9%. This is how they think. It's crazy. So, but now we have a problem where inflation, and you look at this morning's, I don't know when this is going to air, but we look at this morning's ISM services report, showed that inflation is a real problem for corporations. It still is. So the Fed can very well cut interest rates to 0% to bail out the stock market. They might not like the reaction because interest rates on the long end of the curve, which the Fed does not control directly, they would have to actually go and buy those bonds. They're controlling the money market rate by the Fed funds rate. They have to go some massive QE program to buy long-term debt, U.S. Treasuries, which would be hyperinflationary. I'm not saying they won't do that, but they're not doing it now. They're supposedly doing QT, and you could have interest rates spike out of control, which would destroy real estate, would destroy the stock market. So the Fed funds target rate is 4.5 to 4 3/4 right now. If they can cut to zero, they can cut to negative, especially if you have a digital currency, a CBDC. They can cut to negative. Negative 100% if they wanted to. They just say, put your money in the bank, and the interest we're going to charge you is 100%. You have nothing left, so you better not put your money in the bank. You better just spend it. That's what they could do. I mean, I'm using hyperbole, but they can cut rates to zero. They have a lot of room left to go. What would happen to long-term interest rates? What would happen to commodity prices if they did that?
What do you think of Pento's take? Do you agree with him? Post in the comments section down below your honest opinion, and share with the stackers if you think a major recession is coming in 2025 or not. Now watch this video right here because you'll love it, and I'll see you on the other side.